Welcome, your one-stop destination for all things finance and investing. Today, we're diving into the exciting world of stock market investments, exploring three options that are perfect for beginners looking to start their financial journey. Before we dive in, a quick reminder, investing in the stock market is not a get-rich-quick scheme. It requires careful planning, research, and a long-term mindset. And most importantly, you should never invest money you can't afford to lose. That's why we're starting with a crucial step, building an emergency fund. Think of it as your financial safety net, a cushion that can protect you from unexpected expenses or job loss. An emergency fund can provide peace of mind and allow you to approach investing with a clear head and a sense of security. Imagine facing a sudden car repair or a medical emergency. Without an emergency fund, these situations could quickly derail your financial stability. But with a well-stocked emergency fund, you can handle these challenges without dipping into your long-term investment goals. An emergency fund offers several advantages. Peace of mind, knowing you have a financial safety net can reduce stress and allow you to focus on your goals. Financial stability, it can protect you from unexpected expenses and prevent you from relying on debt. Freedom to invest, with an emergency fund in place, you can invest with confidence, knowing you have a backup plan. So, before you even think about investing in the stock market, make building an emergency fund your top priority. It's the foundation of a sound financial future. Now that we've covered the importance of an emergency fund, let's explore three beginner-friendly investment options that can help you start your journey towards financial growth. Stay tuned as we uncover the potential of these investments and how they can fit into your long-term financial strategy. All right, let's get started with your investment journey. Our first recommendation is a powerful tool for beginners, exchange-traded funds, or ETFs, that track broad market indexes.
But what is ETFs?
Imagine an ETF as a basket filled with various company stocks. Instead of buying individual stocks, you purchase a single share of the ETF, gaining instant exposure to a diversified group of companies within a specific sector or the entire market. This diversification helps spread out your risk, meaning a downturn in one company's stock won't significantly impact your overall portfolio. Now, let's talk about market indexes. Think of them as giant gauges that measure the overall performance of a specific section of the stock market. The S&P 500, for example, tracks the performance of 500 large-cap companies in the U.S. Other popular indexes include the Dow Jones Industrial Average, DJIA, and the Nasdaq Composite. So, how do ETFs that track these indexes benefit you as a beginner? Here are some key advantages. Diversification. As mentioned before, ETFs offer instant diversification, reducing your risk compared to picking individual stocks. Low cost. Compared to mutual funds, ETFs generally have lower expense ratios, meaning you keep more of your returns. Transparency. ETF holdings are transparent, allowing you to see exactly which companies you're invested in. Convenience. ETFs trade throughout the day like stocks, offering flexibility and ease of buying and selling. Some popular ETFs that track major market indexes include the VOO, tracks the S&P 500, IVV, also tracks the S&P 500, and QQQ, tracks the Nasdaq 100. These ETFs offer a great starting point for beginners who want broad market exposure without the hassle of picking individual stocks. In the next segment, we'll explore two more investment options perfect for beginners. So, stick around and get ready to unlock the exciting world of stock market investing. Our next investment option might surprise you: bond ETFs. While stocks are known for their growth potential, bonds offer a more stable and income-generating alternative. Bonds are essentially IOUs issued by governments or corporations. When you buy a bond, you're essentially loaning money to the issuer in exchange for a fixed interest rate paid out over time. Bonds generally offer lower returns compared to stocks, but come with lower risk and can provide a steady stream of income. Just like with stocks, you can invest in a basket of bonds through bond ETFs. These ETFs hold a variety of bonds issued by different entities, offering diversification and potentially mitigating risk from a single issuer defaulting. Here's why bond ETFs might be a good fit for your beginner portfolio. Lower risk. Compared to stocks, bonds generally offer lower volatility and are less susceptible to market fluctuations. Steady income. Bond ETFs pay out regular interest payments, providing a dependable source of income for your portfolio. Diversification. Bond ETFs offer exposure to a variety of bonds, reducing your risk compared to holding individual bonds. Hedging potential. Bond prices typically move inversely to stock prices. Including bond ETFs in your portfolio can help hedge against potential market downturns in the stock market. Some popular bond ETFs include the BND, tracks the Barclays U.S. Aggregate Bond Index, and IEF, tracks the iShares 7 to 10-year Treasury Bond ETF. These offer exposure to a mix of government and corporate bonds with varying maturities. However, it's important to consider your investment goals and time horizon. While bond ETFs can be a valuable addition to most portfolios, they might not be ideal for aggressive investors seeking high growth potential. Stay tuned as we explore our final beginner-friendly investment option in the next segment. We'll discuss an exciting option that offers a balance between growth and stability.
The power of diversification, a bonus tip.
Before we move on to our final investment option, let's take a moment to discuss a crucial concept for every investor: diversification. Diversification is the golden rule of investing. It simply means spreading your investments across different asset classes to mitigate risk. Imagine putting all your eggs in one basket. If that basket falls, you lose everything. Diversification helps you avoid this scenario by spreading your investments across multiple baskets, asset classes.
Here's a bonus tip for beginners. Consider a balanced portfolio allocation. You could allocate a quarter of your portfolio to bonds, ETFs like BND or IEF, for stability and income. Another quarter could go into real estate investment trusts, REITs, for exposure to the property market. The next quarter could be dedicated to ETFs that track broad market indexes, like VOO or IVV, for long-term growth. Finally, the last quarter could be for exploring individual stocks or even alternative assets like cryptocurrencies. Approach these with caution due to their high volatility.
Remember, this is just a suggestion. The ideal asset allocation depends on your individual goals, risk tolerance, and investment horizon. However, diversification is a powerful tool that can help you weather market storms and achieve your financial goals over time. Now, let's explore our final beginner-friendly investment option, a great choice for those seeking a balance between growth and stability. Stay tuned. Now, let's explore our final investment option for beginners: real estate investment trusts, or REITs, accessed conveniently through REIT ETFs. Unlike traditional real estate investing, which requires significant capital and management responsibilities, REITs allow you to invest in real estate indirectly. These are companies that own, operate, or finance income-producing real estate properties. By investing in a REIT ETF, you gain exposure to a diversified portfolio of real estate assets without the hassle of directly managing properties. Real estate investing offers unique characteristics that can benefit your portfolio. Stable income. REITs are typically required to pay out a majority of their taxable income to shareholders as dividends, providing a steady stream of income. Hedge against inflation. Real estate values tend to rise with inflation, offering some protection against its erosive effects. Diversification. REIT ETFs offer exposure to a variety of real estate sectors, such as residential, commercial, and healthcare, further diversifying your portfolio. Similar to other ETFs, REIT ETFs offer several advantages for beginners. Low investment minimum. You can invest in a diversified pool of real estate assets with a relatively small amount of money compared to buying individual properties. Liquidity. REIT ETFs trade throughout the day like stocks, offering easy buying and selling options. Professional management. REITs are managed by experienced professionals who handle the day-to-day operations of the real estate portfolio. Some popular REIT ETFs include VNQ, tracks the Vanguard Real Estate Index Fund, and SCHH, tracks the Schwab US REIT ETF. These offer exposure to a variety of REITs across different sectors of the real estate market. Remember, investing in the stock market, including REIT ETFs, involves inherent risks. Conduct your research, understand your risk tolerance, and consider consulting a financial advisor before making any investment decisions. We hope this video provided a helpful overview of 3 beginner-friendly investment options. If you enjoyed this content, hit that subscribe button and join our community of growing investors. Leave a comment below letting us know what other investment topics you'd like to explore in future videos.